Hello, I'm Julia Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using the CME Group event contracts to trade AM EST, NASDAQ, Dow, Russell 2000 gold, silver, euro, oil, natural gas, and copper. Today, I have a great show for you. I have Michael Gad from the Lead Lag Report on. He is a character. I love following him. And today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading those CME Group event contracts. That's what we're all using at Place Your Trades. The PYT team is going to Las Vegas at the Money Show on April 24th through 26th, just a couple weeks from now. So I hope to see you there. Okay, let's bring in Michael. Hi, Michael.
How are you?
Hello, I'm good, thank you. So I am super excited to talk to you today. I'm somebody who I check your feed pretty regularly just to see sort of what you're thinking, what's going on. And I've been pretty impressed. I mean, you're not like a supermarket timer like I am. I'm like focused on lines and levels, but you're more bigger picture. And you're sort of more of a person who, you know, through your research has strong opinions about things. And I mean, you've been pretty accurate so far. I mean, at least for March, he thought March was going to be a month of volatility, which we got, right? And then April, you know, you're thinking that something might be afoot. I mean, do you want to just fill us in on sort of, you know, what your general market view is right now and why?
By the way, you use the right term, opinion. People forget that all this stuff is opinion.
Yeah.
Right? I mean, you can have quantitative metrics and back-tested relationships from here to tomorrow, but in the small sample, if you're going to try and put a narrative around markets, it's ultimately about some kind of an opinion where there are probabilities and conditions, hopefully.
Yes. That's annoying for a lot of people, by the way.
I will say it's nobody can predict the future. No amount of intelligence can increase the clarity of one's crystal ball. And it's like if you're going to make a prediction on the unknowable tomorrow and somebody's going to attack your prediction, which is an opinion on what happens tomorrow, that person's making a prediction. Right? But their prediction is your prediction's wrong. So all this stuff ends up being very silly. Yeah, I've been kind of alluding to this idea that I think third week of April, which would be next week, could be maybe the start of a correction. Now, to some people, that's like a cardinal sin because the last thing you want to do is put an exact time frame on something. The odds are against the bears in April from a seasonality perspective, right? So in other words, April tends to be among the stronger months in pre-election years, tends to be the strongest month. Every single pre-election year, April performance period was positive except for one, which was 1987, the only April pre-election that had negative returns. And I keep going back to my overall thesis for the year is that you're in this kind of melt-up environment with a credit event looming out there, which would be basically a 1987 style type of sequence. The fact that lumber keeps on breaking down so substantially is really bothersome to me, and I think makes it more likely that the 87 playbook is going to be right for April, meaning that we end up seeing, starting next week, maybe the start of a corrective environment for stocks, treasuries countering equity declines, hopefully, which I need in my own funds, ATAX, Frodo, and JoJo. And I put that tweet out like 3 weeks ago or 2 weeks ago. I said, you know, nothing matters until it matters. And when it matters, it's the only thing that matters. And I think housing is going to start to matter again. Keep in mind, I think you and I have spoken about this before. For months, I've been sounding the alarm on housing being weak. And I kept on saying that as you enter the spring and summer periods is when it's going to start to matter for the markets because that's when you start to see more transactions. And as people start to maybe realize just how bad housing is likely to be, the average person that's outside of our industry, outside of investing and trading, they're going to probably start to panic. And that could cause, I think, a pretty nasty sort of air pocket in housing. So we'll see. If I'm right on that, stocks start to discount that. I think it's going to start maybe next week. Could be totally wrong. It's an opinion, folks. But it's ultimately about conditions. And the fact that lumber just does not want to get any sort of recovery is a really bad sign for the home builders, really bad sign for something that makes up 20% of GDP.
Okay, so how do you feel then about, you know, so far over the last couple of months / weeks, gold has been moving opposite from stocks, right? So gold has been going up when the market kind of goes down. It's been going a little bit down. It's going up in general, of course, it has been. But how do you feel about gold during what could be a correction? Do you think that gold will hold strong? Do you think that gold will also correct? What are your feelings there?
Well, I'd argue if gold holds or does well as stocks go down, that's actually standard correction type of behavior, right? So usually gold does tend to act as a flight to safety play, meaning
Right.
in high volatility, there's money that goes into gold, just like treasuries, just like the dollar.
Unless it goes way down, right? If the market goes way down, then money comes out of everything, right?
Exactly right. Everything would tend to correlate. But the point is, like, I think if you see relative strength in gold, against the directional decline for stocks, that would be consistent with, sort of the return of the flight to safety dynamic, which was what was lacking all throughout last year. So I think gold in general makes a lot of sense. Look, I always go back to this idea that gold is really a diversifier. It doesn't correlate to very much except high volatility sequences in stocks. I think a large chunk of this gold move probably is asset allocators basically saying to themselves, you know what, this bear market probably is going to take some time to play out, because I still think, despite the melt up argument, that we're in a bear market. Okay. And if allocators believe that the bear market will take time to flush out, they probably want more non-correlation. So what do? They go into gold at the margin. A little bit of incremental reallocation of gold starts the momentum, which is what we're starting to see. So I like gold here. I think gold is going to probably keep on doing relatively well after a decade of nothingness.
Okay, that's fantastic. So far, I'm loving everything you said, actually, because I would like nothing more than for this week, if we get some kind of spike. We have tried ES, or SPX futures has tried to get above the 4183 area 6 freaking times. This would be the 7th time if it tries again. And I would like nothing more than a huge spike this week, fill that gap above at 4220, and then come careening down. That would be just so awesome sauce. I mean, it doesn't necessarily have to happen, but that would be my grand master plan if I was a psychopath market maker, especially because when it gets up there, every single person is going to start chirping about all-time highs, seasonality, yada, yada, yada. That's when it goes to take people by surprise. Now, it doesn't have to happen that way. It could be that we continue up. It could be that we never get there, whatever. But that's what I, that you talking about next week potentially being, something where that might happen would align with the CPI and the Fed minutes on Thursday, right? That to kind of take us to a point where we can't go down, but then we go down, right?
Yeah, listen, I keep going back to that line. I say, right, bear markets make fools of bulls and bears.
Yeah.
So you have to, pardon the language, you have to fuck everybody with this. All right. So, I mean, that's just the reality. So
yeah, of course.
That's what markets do. You have to mess with the bulls and the bears. I think there's a lot of insane, uneducated speculation that started to come back aggressively. Doesn't have to necessarily resolve right away. But when I see some of the nonsense in the cryptocurrency space, like I'm seeing now, as I saw back in 2021, there is a certain type of mania that seems to be coming back now in the most speculative nonsense parts of the investable landscape. That should give the real smart bulls some pause, right? Because that's typically not a good sign for a continuation, at least in the short term, of prices going higher.
So I'm going to ask a dumb question because, so I heard Mark Cuban talk about that he would prefer BTC over gold any day. And he feels like that's something that will maintain value. Do you think there's any logic to that at all? Like, do you feel that people, maybe the younger generation, I don't know, do you feel like people believe that BTC, because it's a digital decentralized blah, 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 that it's somehow safer or whatever than gold is?
What? I mean, it first of all, safer, as you know, is a loaded term,
right?
As we know, right? The thing is, depends on your objective, right? If you're going to argue that Bitcoin is better at appreciating than gold, that's probably true, simply because it's easier to access, right? Just it's a click of a button, right? And a whole bunch of ones and zeros. If you're going to argue that Bitcoin is a risk-off, better safe haven play than gold, there's absolutely zero evidence of that historically. Now, there could be going forward, It's like, that's the thing about correlations, they change.
Right.
But I find it hard to believe that Bitcoin, given the way that it's viewed and the narratives that are out there, starts to act differently than stocks, especially when you've got very wealthy people making claims like that when they probably have more gold through the amount of jewelry they own than Bitcoin.
Yeah. You never know. You never know what any of those people, Carl Icahn, Bill Ackman, Mark Cuban, you never know what they own versus what they say. Because what do they care if they look wrong afterwards, as long as they're
still rich?
They're still really rich. Like, they're not like us or me,
I'm just another random Joe Schmo here trying to figure it out like everybody else.
Right, exactly. That's definitely how I feel. And when people think that somehow, the amount of followers you have or anything equals, some kind of goddess-like ability to predict things in advance, it's so not true. It's just the amount of time you've spent studying the market, the number of times you try to be right versus wrong. And then just, not being shy about sharing an opinion that maybe a lot of people don't have. And that's what makes somebody, I think, possibly have more followers. It doesn't necessarily mean that they're right? Because a lot of time, I've definitely been early before. I've been wrong before.
Everyone has been.
That's right.
So is Warren Buffett. You're going to get me on all rant on this. Like, who was down 50% twice in his career? Warren frickin' Buffett. But you're right. That's why I keep going back to the word of this conversation is opinion. It is all an opinion. But I go back to when everybody shares the same opinion, everyone's betting on the same pot, right? And if everybody's betting on the same pot, it's not that the opinion is going to be wrong. It's that if the opinion is wrong, the payout is higher, not betting on that pot, but betting on another pot, right? Which is, I keep going back to contrarianism is not about doing the opposite of the crowd. It's where is the expected value highest, where fewer other people are betting on a particular outcome, even though the pot may be smaller. You're splitting it among fewer number of bettors. So who knows? You're right on Bitcoin and gold. But it's like, at the end of the day, all these very wealthy people that make arguments for cryptocurrencies, unless they were among the very early Bitcoin investors, their wealth is from fiat. That's not going to change.
Yeah, you're 1,000% right. So I want to ask something. So if somebody wanted to become sort of their own version of a contrarian, like when you were getting started in your career, how did you decide what things to look at? How did you decide that lumber was important? I know you've published several papers that have been, I don't want to use the wrong term, award-winning, I don't know, but that have had critical acclaim, that have tended to be correct over most of the time. So, how did you even formulate how to look at markets? Let's talk about somebody who wants to become not just a listener, not just a follower, but somebody who is, can think for themselves and who wants to have their own opinions and not be swayed. How did you do that?
You have to like pain. And I'm very purposeful when I say that, because I really do believe this. I think if you are naturally an introvert, you're going to probably lend your thinking more towards contrarian thinking. If you're an extrovert, you're seeking approval from the crowd, which means you're probably going to go with whatever the crowd is saying or thinking, because that's what makes you popular and that's what gets you to have more conversations with other like-minded people that think and share the same view.
Yeah.
When I say you have to like pain, what I'm referring to is you have to like the feeling of rejection, or at least be acceptable of rejection. Because if you're going to be contrarian, you have to be willing to be rejected by the crowd and insulted by the crowd because you're saying or thinking about things differently than the crowd. And that's actually rooted in a lot of interesting physiological studies. So it's been shown, for example, that the feeling of rejection, your brain interprets as being in physical pain, which kind of makes sense. If you're not a part of the crowd, your brain actually views rejection as being physically painful, because you go back to our woolly mammoth caveman times. If you were not a part of the crowd, you were more likely to get killed by the woolly mammoth, right? Because you're much more likely to survive in a group than running by yourself. So going back to your question, how did I form my own way of thinking about things? It's more than just how did I form it. It's about sort of what's my genetic makeup, right? I tend to be more of a, believe it or not, despite my loud social media personality, more of an introvert.
I'm an introvert too.
Yeah, I tend to be very, very skeptical of most narratives, even though I know you need to have narratives because that's story selling. but I'm skeptical of narratives. I get frustrated when I see the crowd saying things which, if you just asked a few secondary or tertiary questions, you find out the crowd has no understanding of what they're believing in. And it goes beyond just markets. That's just everything: politics, philosophy, life, everything. And if you have that sort of mindset, then as you start researching and studying markets, you also start to be skeptical of what you're reading, which means it forces you to backtest. It forces you to actually question, to look to the left of the equal sign, not just accept what is some crowd aphorism saying, here's support and resistance, and every time you hit support, you're going to bounce back. Okay, well, let's actually test that, right? But my point is, like, it's very hard for people to think in those terms unless there's something in their personality, something in their DNA that makes them not want to be a part of that average dynamic, which means they have to be willing to accept some pain, whether they like it or not. Maybe that's the wrong way of framing it, but some people apparently do. You have to at least be willing to accept that pain.
I love this conversation so much. You have no idea, because I'm just hearing everything I thought about myself, and coming from you though. And so that's like wonderful. Did you build computer models though? Did you manually look through the charts and say, okay, this is where it's at? What did you do from an analysis perspective?
Backtesting doesn't have to be terribly complicated. I mean, a lot of my backtesting was from my TradeStation automated trading days, using easy language to try to code and test and do all kinds of things.
Yeah.
Realizing how little things there are that actually have predictive power, right? To have that skepticism as to why people say markets go up when in reality, if you test it, there's no predictive power. You mentioned those research papers. All the research papers basically say the same thing in different ways. There are leading indicators to volatility. Those leading indicators tend to be tied to the cost of capital, changes in demand for money, liquidity, and that there's, on average, some kind of a lag you can maybe take advantage of when it comes to lumber being weak relative to gold and how it impacts markets with a delay. Utilities outperforming the market, how it impacts stocks with a delay. Long duration treasuries against intermediate, how it impacts stocks with a delay. It's that delay that's the key. Now, the nice thing is that I think we're entering a more, in quotes, normalized cycle where this stuff matters again, because the reality is the last decade has been really, really abnormal in the context of market history because of QE3, because of the SERP, distorting all these intermarket relationships, making it all about the S&P, getting rid of the left fat tail largely, except for late 2018 and early 2020. The COVID crash. If you're going to build an approach, you have to build an approach based on more than just a decade's worth of data. You have to do it based on cause and effect and as much data as you can. That's why you have to even be skeptical about the way stocks behaved the last 10 years. A lot of people, I think, have entered the market in the last decade thinking that what we saw the last decade was normal. Far from it. It was one of the most abnormal cycles you can imagine, with it being purely about FANGs.
Right. I mean, I remember when Kramer first came up with the FANG. I don't know if he came up with it, but he first stated the FANG acronym, and I was like, oh no, this is going to be a thing, like a huge thing. And, because I tend to be contrarian in nature, it was really hard for me to accept that this was just going to continue indefinitely. It was something I just had to deal with, because everybody thought it was going to go up and it still went up. So what you said basically is just looking at the positioning. I mean, it's critical when you are a contrarian to sort of know when you're just disagreeing because you're contrary versus when you're disagreeing because you believe that we're at an inflection point and there's the highest risk reward to going against the crowd. So back to your prediction. So I think I shouldn't call it a prediction. Back to
the conditions favoring the probability, favoring the outcome, right? As I always say, right?
Yes. Back to your conditions that would give a high probability favoring the outcome of a pullback over this next week. Do you believe after a good sized pullback, you mentioned earlier, you believe this is in the context of when they're melt up. So you don't believe that potentially this pullback that we might, if we do experience a pullback, it might get to 3,200, like everybody. And I don't want to say everybody, like a lot of people feel is likely on a big pullback, or do you think it'll be like a medium-sized pullback and then go higher? What do you think?
Yeah, I mean, it could. I mean, I think the NASDAQ probably has to go through the bulk of that 10-15% type of correction. I mean, NASDAQ's up, what, 21% for the year?
Yeah, it filled its gap, unlike ES, which is why I want ES to fill its gap.
Right.
And yeah, right.
So it probably has to be centered probably more around the winners, right? I mean, small caps have already gotten taken to the woodshed. So if you're going to have a decline, it's probably not going to be as severe, I think.
Right.
Right.
They're what I call the weakest link.
Yeah, right. But the point is, like, they've already gone through a correction.
Right.
I mean, it's so maybe it continues, but on a relative basis, I would think that the NASDAQ gets kind of the most hit. But I mean, again, you never know. I think if you're going to have that 3,200 S&P type of level, and I'm not a huge fan of levels, but if you're going to cross that type of threshold, that would be consistent with a credit event. That would be exactly what I've been referring to as what could happen later in the year, which, again, I could be totally off on the timing, but if there's a credit event, that's going to cause that real nasty collapse in equities. That causes probably treasuries to rally, the return of the flight to safety dynamic. We started seeing some of that in March.
Yeah,
I wouldn't mind seeing that. It's like people think that when it comes to my funds, right, they're all variations of the same idea. They're all rules based, so they have nothing to do with my opinion. Right? They're going to position based on these indicators. People think when I say melt up, they think that that's my way of expressing wishful thinking because that's how I'm going to come back on my funds after the drawdown from last year. It's like, no. I mean, Roro's not up 28% for the year, roughly, because of equities. It's because of the rotation across equities and treasuries, the flight to safety trade coming in and out. My bias is always to see volatility, right? So the way that what I would love to see is, selfishly, I want to see it because that's how I can stand out with these funds that I launched. But I think there's a lot of intellectual honesty in arguing that stocks will go up and down.
Well, rather than sideways, right? Because that's another thing. I mean, for the longest time, we were going up by like less than 1%. And that I consider that sideways because it was tradable. But let's be real. Most traders, if there's not high volatility, will make more just as an investor. In a high probability, in high volatility environment, traders can make more than investors. But in a low volatility environment, investors, I think, will beat 95% of traders because you have to be super exact to make money on something that's moving less than 1%. And not a lot of people have awesome lines
right.
like me. No, I'm just kidding. But it's true. It's just true in general. That's why, at least initially, that people were saying that just invest, don't worry about it. But in this high volatility environment, if you are somebody who can time things, even not perfectly, but just ish, then you're going to make more money than an investor will just holding flat. That's why I'm interested in trading these event contracts. That's why I'm trading futures, because I feel like if there's a time to make a lot of money, it's now during the high volatility before it could go lower and stay lower, right? Or it could go higher and stay higher. But while it's doing this, it's the time to make money.
Yeah, I mean, it's you always make more money buying low and selling high than buying high and selling higher. I mean, that's just mathematically true.
Right.
Because, if you get the low point, you're compounding from a lower base. The thing is, I don't think that we've seen the real high volatility yet. And part of last year is the frustration that I've had is that, yes, it was a volatile market, but you didn't have these kind of super spikes in vol. I had a lot of people in these Twitter spaces that I run say that last year was the only year where they lost money on hedges because it was volatile, but it was like volatile-ish, to use that kind of terminology, right? So in a credit event, you're going to get a VIX spike. You get a VIX spike, you're going to have a real buy low, sell high type of moment. And that's where a lot of real wealth can be made. But the thing is, as you know, people get impatient. They keep trying to, in my case, I have to do it because that's the mandate for my funds with the prospectus, but discretionary traders will often try to be impatient, trade, instead of wait for the fat pitch. There's going to be a fat pitch at some point this year, right? I don't know if this April correction brings it. If I'm right, that's next week is where it starts. Maybe I'm wrong. But there is this credit event that's out there. And if I'm right that the credit event is out there, that's where there's going to be some real money to be made.
Well, let me ask you about that. So if there is an event, do you think that it's something that will happen quickly, like a flash event, and then boop, right back up? Or do you believe that it's something that will last for weeks and months?
It's a good question. It's hard to know on the path. I suspect it has to be very aggressive, right? And then doesn't have to V right away, but it probably has to be something very sharp to get a lot of people off sides. Look, a lot of people made money shorting last year because there was a degree of consistency, right? In the number of weeks that the S&P 500 lost money, you're not supposed to be able to make money shorting the market consistently, but last year was unusual in the path behavior of equities. The way you screw both longs and shorts is by making the decline so fast that nobody can take advantage of it, including the shorts.
Right.
Right. So I think it's more likely, not to say that you necessarily would have a crash, although the conditions might be there for it at some point later in the year. But it almost has to be very swift. Now, coming out of it, who the hell knows, right? It depends on what the Fed does or doesn't do. I always go back to 1987, you had a melt-up. 1987, you had a crash. 1987, you had a Fed pivot. It's not impossible to see all this happen in the same year.
Do you think, and I mean, I know you're not this kind of guy, but I do want to ask you, do you believe if we do have a major event, whether it's now or later, do you believe that the Fed can fix it?
No. Fed is not able to fix anything. All they can do is just change where the pain goes to, right? I mean, so they reliquefied the market after the GFC, and they reliquefied the market with post-COVID. And where did all the pain go from the deflationary shock? Went to every single person paying for basic goods through inflation. Right? I mean, the Fed's never able to fix anything. All they're doing is just shifting where the pain goes to and hoping that it's not there long enough for whoever is suffering that pain to, take the pitchforks out. The Fed is very good at coming as a savior to their own problem that they created. I mean, that's just the history of the Fed.
So even if they launch something similar to COVID, like what they did for COVID, you don't believe they could get us out of a situation?
No, what's interesting about that way of thinking? This is one of the things that would really bother me throughout 2021. You had the vaccine, and you had all the stimulus, you had the reopening trade, and small caps, which are most sensitive to the domestic economy, peaked in February of 2021. It didn't make sense to me throughout 2021 that you had all of this stimulus, everything the Fed was still doing back then, and yet the average stock was not participating. That is a perfect example of the idea that the Fed cannot control the stock market no matter how much they're printing money, because it didn't work in 2021 for the vast majority of stocks.
I vaguely pay attention to that stuff. I do pay attention when the government tells me or makes statements that it's clear what their motivations are, because I feel like they get what they want, whether or not macro lines up for it or not. But when government says something like they want a particular commodity low, it's like, I bet they're going to get it. Don't know how they're going to, but it just tends to be right a lot of the time. But yeah, I don't really pay attention to that stuff. It's interesting, and just because I don't think we've ever talked about it, you do have the 3 funds there. What are they and why did you start them?
Yeah, no, I appreciate that. I mean, they're all variations of risk on, risk off type of rotations, either going into equities in the case of ATAX and RORO, or high yield in the case of JOJO as the risk on expression, or treasuries as the risk off, safe haven, beneficiary of stock market volatility expression. They're all meant to be alternative, all meant to be diversifiers. They all need to some extent a tail event to really stand out. Like ATAX, my mutual fund, was up 72% in 2020 because you had a crash in 2020. So nature of my approach is that it tends to lag on the upside unless you have a few of these risk on, risk off dynamics between equities and treasuries, and then really make it up on the downside by being in treasuries as stocks go down. Last year was a notable exception because stocks and treasuries both collapsed in the same way. Right? So they're rules-based, meaning I can't override them, and the rules-based meaning that in a year like last year, there's nothing I can do but take the pain. But they are designed to really play off of volatility. So if we re-enter a period like the post-QE3 or mid-90s period of a very smooth bull market, don't touch my strategies. If you believe that there's going to be more volatility pulses, all that means is I have a chance, which is like the worst selling point, right? It's like these funds have a chance at maybe getting the risk off, safe haven side of things right, but RORO and JOJO have indices tied to them. You can look at the indices, their back tests, but you can see, at least in theory, how these rotations have performed historically. And ATAX, had its kind of real war story in 2020. I don't know if I'm ever going to get another juncture like that, but I know that there's still more risk out there. And if there is more risk out there, that's one way to stand out.
I absolutely love it. Well, thank you. Is there anything else that you want people to know that, I mean, I know you're a prolific tweeter. Is there anything that you want people to know about you or your funds or your strategy or anything like that that you want to share with me that might be misunderstood about you? Or what do you want people to know about you and what you do?
The main thing I would say is people have to, and I see this a lot on FinTwit as a problem, people are unable to differentiate between me as an analyst, thinker, macro guy with the lead lag report and my funds, which have nothing to do with me. I launched them, I created them, they're my intellectual property as the guy that's the architect behind them. But I'm not doing discretionary rotations on it. So if I die tomorrow, the funds run the exact same way. If I die tomorrow, the lead lag report no longer exists. Right? That's a big difference. But I think the main thing is for anybody that's listening to anybody, whether it's me or any other macro person or trader, it goes back to the earlier part of how we started the conversation. Keep in mind, everything is an opinion.
Right.
Everything is based on an unknowable tomorrow. You have to make your own conclusions, and you have to look to the left equal sign, which means you got to be willing to take the pain of being contrarian when everybody tells you you're stupid for thinking differently.
I feel that so hard from the times that I've shorted Tesla when it was on a parabolic curve. I got blocked by a lot of people. I was successful even, but it doesn't matter. People don't want to hear things that they don't agree with. But okay, That's great. Thank you for sharing that. I appreciate it. I think this has been a wonderful conversation. I learned a lot that I think I can use, actually. So thank you. I appreciate it so much. I would encourage anybody who's listening just to click around this site because there are some tools that you can use. If you scroll down on this live window, you're going to see like some quant stats that you can use every day that give you probability odds of things happening if we gap up or gap down. And I think they're pretty useful. I check them every morning. All right, everybody. Thank you so much. Have a great trading day, and I will see you on the interwebs. Okay, bye.